All right, so Christian, what I've got on the board for you is kind of the fundamentals of accounting. Every single transaction that occurs within a business has to wrap up into this equation and this balance sheet. Okay, so we're going to take a few minutes. I'll walk you through this. If you have questions, let me know. So this is your basic accounting equation. Everything that occurs in accounting will somehow fall into a component within this equation. So for example, assets indicate what a company is worth, okay? It's everything that the company owns. Cash, money coming in from clients that have either purchased a product or purchased a service. Inventory, that's considered an asset. Property, plant, and equipment, and land. We'll talk a little bit more about these here in a minute, but that's all of the asset side. Okay, so it's everything that generates worth for the company. On this side, on the right side of the accounting equation, you have liabilities plus owner's equity. Liabilities is anything that is owed by the company. Okay, so if they've incurred any kind of debt, then it would go in this bucket here. If they have an outstanding note of some sort, a mortgage, things like that, anything that the company owes is going to be a liability. Okay? Does that make sense so far?
Yeah, it makes sense so far, yeah.
Okay. Then we have anything that's left over, and that's called owner's equity. Okay, and it's kind of a bucket of residual items. When we start looking at the balance sheet, we'll talk specifically about some of the things. But in essence, you have whatever the company's worth, okay, and then you have your liabilities plus any residual items over on this side, okay? And this equation always has to balance out. So in other words, when you add up liabilities and your owner's equity, it always has to equal the assets, okay? So there can never be one side heavier than the other. So how all of these are tracked? They funnel down into the balance sheet. And the balance sheet is probably the most important financial statement of any company, because the balance sheet shows where the company stands at any given point in time. Okay, so it shows what the value of the company is, shows what their liabilities are, how much they owe. So anytime they generate a balance sheet, it shows whether or not they're basically where they have enough assets to cover their liabilities or whether they don't. So you can kind of see where they stand. Okay, the balance sheet and the income statement are probably the two most important financial statements of any company. Okay, so your balance sheet then is divided. Takes this equation and then it divides it basically down the equal sign. Okay, assets are going to be always on this side, liabilities and owner's equity are going to be on this side. And the main thing to take away is that at the end of the day, both of these totals have to match. Okay? Okay. So, on the asset side, okay, if I asked you what you think your main asset was, just you as an individual, what would be some of those assets?
How much money I have on me,
okay,
what the clothes I'm wearing.
Yep.
Probably just the things I own, pretty much, like my phone, wallet.
You have a car?
Yeah, I have a car, yeah.
Okay. Key asset, yeah. So anything that you own, your cash on you, the cash in the bank, mm-hmm, all of those things are assets, and they would fall basically on the left side of your balance sheet. All of those things total up, and you get your grand total of all of your assets. Accounts receivable is money that is due the company. So if you and I, say I was a business, and I was selling you widgets, okay? So I make this widget, nobody else makes it, and you have to buy this widget from me. When I sell this widget to you, you now owe me money. Either you pay it as cash, or you give me a promissory note, or I keep it on account, and at the end of the month I send you an invoice. You owe me for this widget. So any money that is coming in that is due me, that I have not received via cash, I put into this accounts receivable bucket. Okay, so it's money that I'm yet to receive. So that's a key asset for most companies. inventory, surprisingly, especially for your big companies like Walmart, anybody who sells a lot of merchandise, inventory is most of the time one of their largest assets. And you think about how big Walmart is and their distribution centers and so forth, they've got to have a lot of inventory. And then for manufacturing facilities, you have what we call PP&E, or property, plant, and equipment. And that's your buildings, any kind of manufacturing equipment, things like that. And usually those are pretty significant value as well. And then of course you have land. Land is also considered an asset. Okay, so does that make sense on the asset portion of the balance sheet?
It does make sense in the asset portion, yes.
Okay, great. All right, so now we jump to the other side. When we look at the right side of the balance sheet, we have two categories here, liabilities and owner's equity, again filtering down from our accounting equation. Liabilities are basically all payables, anything that I would owe as a company. So for example, if I am running a business and I'm consuming electricity, I usually will pay electricity, well, it kind of depends. If I'm paying based on consumption, then I'll consume over a month, and then at the end of the month, I'll usually pay the invoice or pay whatever it is that comes in, okay? So anything, well, actually that's an expense, a different payable. Okay, so mortgage, okay? Eventually you'll own a house. A mortgage is a type of payable because you owe it to the bank to pay back a loan if you've purchased a loan from them. There's accounts payables as well, which would be anything that I owe anybody who I've borrowed money from. And then you've got notes payable, which again, typically that's other, bank notes as well. So if I have, say I have a huge piece of equipment out there and I had to take out $1 million loan, that would go on my books as a note. So any kind of payable, any kind of liability, if I owe somebody something, it's going to fall into this area here. Okay? Okay. And then last, anything that's left over, anything that's not classified as an asset, not classified as a liability, it's going to get kind of dumped into owner's equity. Some of the most common things that you see in owner's equity is if we have any kind of investments, if we've sold our company stock, say I'm Amazon and I've decided to go public and I'm going to sell stock in order to bring in money. Those stocks those issued stocks would then be calculated or recorded in this area. Okay, so any kind of instrument that results in people paying me money to own a piece of my company. Does that make sense? That's what they would consider paid in capital. Okay, and then retained earnings, revenues, income. This is all of the income that my company is generating because of me selling whatever it is I'm making, whether it's a widget, whether it's a service, any income, any kind of revenue, it's all going to get dumped here. Okay? And then usually if I have to make any kind of contribution to the company, that's going to go into owner's equity as well. And the bottom line is that both of these sides have to equal each other. Now, how that works, okay, up here in blue, I've got here, it's called debit normal balance and credit normal balance. So every time I do a transaction, I've got to record it into what we call our general ledger. The general ledger is basically a book or a software program where I record debits and credits. Okay, every account in that general ledger will have a debit or a credit side. If they are considered an asset account, in other words, they fall on this side of the balance sheet, they're going to have a debit normal balance. Meaning, as long as it's positive, as long as, so example, if I have more cash in the bank, then I'm going to have a positive balance in my cash account, and it's going to be on the debit side of that account. Does that make sense?
Yeah.
Okay. Every time I take cash out, I'm going to credit that cash account. Okay, so a credit transaction will reduce my will reduce my asset, and it will usually increase something over here. So that's why we have a credit normal balance over here. So all of these types of accounts, all of your liability accounts, all of your owner equity accounts, they're going to have a credit normal balance. So anytime I want to increase these, I would basically add a credit to my general ledger for these accounts. Okay, and that's sometimes hard for individuals to understand. A lot of times what we'll do in accounting is create what we call little T accounts, and that kind of helps to see how these transactions work. So, one of the things that we can look at, for example, is cash. If I create a T account for cash, okay, the debit side is always over here, okay? So if I want to increase cash, I'm going to add the amount here. If I want to decrease it, I'm going to put it here. So when sales occur, okay, if I sell my widget to you and you give me cash, which side, so let's say you give me $10 for my widget, which side of that cash account am I going to put that $10?
You're going to put that in debit.
Yes, okay. So what'll happen then is now I will have $10 as a debit. My cash account has increased by $10, and it just keeps going per transaction. When money's withdrawn, let's say I have to pay a creditor, then maybe I have to pay them $100. Now I've paid out $100. The reality is, if I'm in the red, if my cash account is, if I've overdrafted or if I've taken out more than I have, then you can see here that I actually have a credit amount of $90, which means that I don't have enough cash. Okay. You always want your debit normal balances side, you always want the positives on that debit side. Okay. And the same would hold true for the credit side as well. Questions?
Okay, so I was trying to overhear you when you were talking about stocks and paid in capital. Could you repeat what paid in capital was?
Okay. So, you're familiar with investments, the stock market?
Yes.
Okay. So, as a company, if I was going to go public, that means I'm going to be selling off a portion of my company. And I'm going to be putting it out there on the stock market, and investors are going to purchase that stock, and therefore those investors are now going to give me money and hold a piece of the company as the stock. Does that make sense?
Yeah.
Okay. So what happens then is they have that stock certificate, and I have the cash, and I can use the cash any way I want to help generate more revenue and so forth. So when I have this on my balance sheet, okay, these stocks basically indicate how much stocks I've issued, how many stocks I've issued to other people. This shows who outside of the company owns part of the company. So if my company is worth, I don't know, let's say overall I'm worth $1 million, I can, if I need more money, say my assets right now are at $1 million, but I realize I need $2 million, I can now sell off pieces of owner's equity to increase my cash account, in essence. So I'm going to try to take it from 1 million to 2 million. And by doing that, I have to record those stocks. Does that make sense? So yeah. I'm going to sell $1 million worth of stocks with the hope that I'll get $1 million in to put into my cash account. Well, because other people own those, I have to keep them on the books because they're basically helping me own the company. Okay? And that's where I'm going to keep them, is in the owner's equity section of the balance sheet. So this shows what my ownership is, I guess you could say, if I've issued stocks or if I've issued any kind of other investment type instruments that give me money but takes ownership somewhere else. Does that make sense?
Yeah, it makes sense.
And that's what it means by paid in capital. I've gotten capital from third-party individuals by issuing stock. They've purchased the stock, they've given me money, they now have the stock certificate, they now own part of the company, I have the cash, and I keep their ownership percentages or their ownership amounts right here in owner's equity. Okay.
Okay.
In essence, that's what it is. Did that help at all?
It helped. Yeah, it helped a lot.
Okay.
I just figured out about, well, I mean, because I know when it comes to doing finance and accounting, I just didn't realize there's a whole equation to it. I just thought
Oh, yeah.
you just calculate how much you get and calculate how much you pay. I thought that was all it is.
Yeah. No, and actually, this is the equation this is called the accounting equation, because every single transaction has to affect this equation. Now, we can see how this equation wraps up into the balance sheet. But there's actually another equation that I can put up here as well if you want to look at income and expenses. If you want to do that real quick, I can erase this, I can put up some more information, and then we'll go from there. Okay. All right, so the second financial statement that a lot of companies look at, and it's critically important to basically monitor, is the income statement. The difference between big difference between a balance sheet and income statement is that a balance sheet is one point in time. An income statement is usually covering an entire period. So you can have a quarterly income statement, you can have a yearly income statement. So in essence, it is tracking your income and your expenses over a period of time. Now, the income statement basically supports this particular accounting equation. And it's pretty intuitive. Revenue minus expenses equals net income. So all of your sales, all of the income that your company generates will float up into revenue. Anything your company spends, whatever it is going to be considered an expense. And then whatever's left over is considered net income. And of course, you want your net income to be a positive number. If it's a negative number, then that means you're operating in the black. I'm sorry, you're operating in the red, in the fact that eventually you're going to run out of money. Okay? So, revenues is usually the top part of the income statement, and companies can set up income statements in a lot of different ways. So this is just a basic generic income statement. Usually what you'll see is revenues first. Revenues, anything that brings money into the company. It could be sales of merchandise, sale of a particular good, it could be sale of a service. So anything that's going to create money for your company, you're going to put in here as a revenue, okay? You will add up all of those revenue streams and you'll come to what we call total revenues, okay? Now, before we jump down to the red, there is a cost. It's called cost of goods sold. And before you start throwing in all of what we normally think of expenses, you have to figure out what your cost of goods sold is. Now, the cost of goods sold is any cost that is associated with creating your revenue. So if I'm selling a widget, anything it takes me to build or create or pay for that widget is going to go as a cost of goods sold. Okay, so you want those particular costs to come out first. And what then that gives you is what we call gross profit. All right, and that's when you're seeing, in essence, how things are flushing out with regards to whether or not you're actually making money on that particular product or that particular service. So that's why you want to relate anything that's associated with that product as far as the cost of making or producing or delivering that product. You want it all to wrap up in this cost of goods sold, because you want to know, are you making money per unit of whatever it is you're selling? Okay, does that make sense?
Yeah.
Okay, so once you figure that out, then you have all of these other expenses that may or may not necessarily be associated with that product. For example, a good example that I like to give people is most of the time you're going to have the cost of your assembly line or whatever it is, the cost of the individuals who are providing the service or doing the production, creating the product. All of those types of salaries will wrap up into cost of goods sold most of the time. However, some of the salaries, for example, the CEO, very seldom do you see, like the CEO of a company, you don't see their salary wrapping up into cost of goods sold, because they're very seldom setting foot into a plant and actually working on developing a widget. Okay, so you're going to have some salaries that will fall into what we call overhead, And anything that is outside of this bucket is considered an expense or an overhead, and all of those will fall out here. Okay, so it's the additional expenses of doing business. All right, and that'll be like your, it could be general and administrative type expenses, salaries, marketing expenses, insurance, if you have insurance for your employees and so forth, rent, all of those things that can't be put into cost of goods sold are going to now fall in here. So once you get all of those calculated, you then come to a total expense. So you can kind of see what your gross profit is. This tells you, am I making money on the sales and services specifically? In other words, is it costing me more to make them than it is to sell them? Okay, and if so, got to look at some realignment there. Then, is it costing me more to operate my business than actually produce and sell my widget? And then you can look at your expenses from that perspective. Once you get your total expenses, you come up here, you take your gross profit, you subtract out your total expenses, and you get your net income before taxes. Okay, and then once you have that, then you send it all over to your tax accountants. They're all the experts. They do all of their tax calculations. They give you what your tax expense is going to be. You put it in here, you subtract it out of your net income before taxes, and then some people call this net income after taxes, or better known as just net income. Okay, and this basically tells you if you are operating the business in a positive or a negative way. In other words, are you making money or are you losing money? So if this is red, you're losing money. If it's black, then you're earning money. So, and then of course, all of this, whatever the result of this is, will wrap up into that balance sheet in owner's equity, where it talked about revenues, earned income, and things like that. Okay, so that's how this eventually wraps up into your balance sheet. All right. Now, the thing to think about, I guess, we talked about normal balances. So, once again, all of these have accounts. So if it's listed here as a revenue, cost of goods sold, if it's listed as an expense, those will all have counts in what we call the general ledger. And again, your general ledger tracks all of your transactions. And in that general ledger, when you track your revenues, the revenues are going to have a credit normal balance. Okay, so that means they increase your revenues. So whenever you're wanting to increase the amount you have in sales, you're going to credit that account. Okay, and then the expenses is the opposite. Expenses have a debit normal balance. Okay, so if I incur a salary expense and I have to pay it here as an expense, I'm going to debit that particular salary expense account. Okay, and that will increase the amount of that salary expense that I've paid. Okay, so whenever you debit an expense account, it's basically keeping a running tab of all of your expenses that are associated with that particular item. Okay, it would be like, so if I was maintaining my own records, every month I pay my utility bill. Okay, I would have a utility account in my general ledger. Because it's an expense, it's going to have a debit normal balance. So whenever I incur utility expense, maybe it was $100 in January or $1,000, whatever it is. In January, maybe it was, $2,500 in February for whatever reason. But if the utility company were to issue me a credit, maybe I overpaid one month and I need to reduce that account by $500. Maybe they say, here, you overpaid, here's your refund for $500. Then I would come in here and take $500 out of that account. And so by having a T account and a general ledger, and this is all done electronically these days in your accounting programs like Sage and QuickBooks and things like that, it's always going to basically tell you what kind of balance you have in that account. So here you can basically see that I've got $3,000, a $3,000 expense on the book that's related specifically to utilities. Okay, so that's kind of how the debits and credit side work. And just knowing that credits increase sales and services and revenues, other income, and then on the expenses side, it's the debits that will actually keep a running total of the amounts for those expenses. So, okay. Okay, that's the income statement. That's revenue and expenses and net income. Questions?
Okay, so I was kind of confused because on the other one,
Yes.
Credit meant that you owe, and then debit meant that you received. So in this one, it'd just be reverse. Like, what's the reason behind it being the reverse?
Okay. Well, you know, I didn't create the accounting methodology, but when I was taking my accounting classes, and it's something that you just come to memorize, unfortunately, in the accounting world. So you have to think of it as, because there's the correlation is just the fact that you're always going to have to debit something and credit something else, and it depends on where it sits on the balance sheet. So, okay, so revenue and expenses, they all wrap up onto the right side of the balance sheet in the owner's equity section, okay? So because of that, you have to kind of look at it as if it filters down. So we have assets equals liabilities plus owner's equity. Okay, and our revenue and expenses wrap up into this. Okay. Now, what credit balance or what normal balance is this side of the balance sheet? Okay, assets, these were debits.
And on the other side's credit.
Credits.
Okay.
Okay. Now, because you have to look at these things, so income and expenses oftentimes tend to offset themselves. They go against each other, okay? If you increase your income, you've probably also increased your expense in some form or fashion as well, because you've incurred an expense usually to generate that income. It's really kind of just understanding that when you get down here, your revenue is your income. And when we increase this side of the balance sheet and we bring in revenue, we are basically increasing our owner's equity. We're also going to, ideally, we're also going to be increasing assets as well. But because debits and credits always have to offset, you have to keep that in mind when you're creating transactions. I don't have, I guess you could say, a great explanation for why it's done this way, except the fact that you have to have offsetting sides. You have to have debits and you have to have credits, and there always has to be offsetting in that transaction. Okay? So if I'm going to be increasing my revenue, which increases my owner's equity, then in essence, these are both increasing using credits. But expenses take away from my revenue, and expenses take away from my owner's equity. And because a credit normal balance here increases those, I can't issue a credit as an expense. Does that make sense?
Yes, it makes sense, yes.
Okay, so that means then my expenses have to be debits, because my debits are decreasing my revenues and they're decreasing my owner's equity. Okay?
Okay,
So it
yes.
has to go against the credit normal balance.
Okay.
Okay.
I get it now. That makes more
Okay.
sense.
Yeah. So there always has to be some sort of offsetting. I know it can get a little confusing. What else? And it's interesting because I often have to really think about it too, because for example, if I'm increasing my expense, I'm going to increase my expense using a debit, and that means I'm also withdrawing cash. So okay, so what does that mean then? What am I going to be crediting, and does that really make sense? So if I debit my expense to increase my expense, then what am I crediting to reduce my asset? What's on this side? What's your biggest asset? Or what's your favorite asset?
Favorite asset is the money you have.
Cash.
Yes.
Okay. So cash, when I decrease cash, okay, because it has a debit normal balance, so if I want to increase my cash, I have to debit my cash. If I reduce my cash, what do I have to do with it?
You have to credit it.
I have to credit it. Okay? So a credit goes down. My expense, in order to increase my expenses, what do I have to do?
You just
I
debit
have
it.
to debit it. So you can see here, once again, you have to have your offsetting debits and credits. So increasing my expense, in other words, I've incurred more of that expense, whether it's a salary or rent or electricity, any of those types of expenses, I would have to debit that expense. And I think we used salaries earlier. So if I need to pay somebody, I'm going to capture my salary expense. I'm going to debit, I'll debit them $1,000, okay? And then I usually take it directly out of cash. And then again, that cash will then be a credit. And this is typically what you see when you capture a journal entry in your general ledger. So every transaction wraps up into what we call a journal entry. And that journal entry basically has to have a debit and a credit side. And if your accounts are classified correctly, then they're always usually going to offset. And so in this journal entry, you always capture your debits kind of staggered off to the right a little bit, and your credit is usually staggered off to your, to your left a little bit, and then your credit's always off to your right a little bit. So you can see here that in this journal entry, my debit would clearly be salary expense. So I'm increasing the amount I've paid in salaries, and then I'm taking that money out of cash, and therefore that's my credit. Okay, so when you see they're kind of offsetting, this would be the debit side, and that would be the credit side. Without getting too complicated.
I think that should do it.
Okay.
For his needs, we can help him with the rest.
Okay, so does that get you started?
Yes, it does.
Okay, any other questions?
At the moment, no.
Okay, well, if you have anything else, or if any other questions come up, feel free to email me, give me a shout or whatever, and I'll help you any way I can.
No, thank you so much.
You're very welcome. Okay, so then you want me to talk a little bit? Okay, so
Right.
come join us in the physical education activity program. If you haven't taken a Kines 199 class, we offer all different types of activities. I particularly teach tennis. My husband teaches golf, so we have tennis and golf, canoeing, pickleball, badminton. We have yoga, we have dance. There's all sorts of activities. We also offer Kines 223, so if you still need a science credit, you can take a 3-hour Kines 223, or you can take a Kines 120, I believe, is the 1-hour credit, and it's a science credit as well. So, and they all have activities associated with them. So if you have any questions, feel free to come and ask.
Good way to work off the stress in the freshman 15, right?
Absolutely.
There we go.
Highly recommend it. Yeah, we burn lots of calories.
Awesome. Thank you for having us today.
Sure, you're welcome.